Hello, we are live in Zoom and in Facebook now. My name is Raimo. I'm head of partnerships at the E-Residency team, and today we are talking about taxation in Estonia. We are holding currently the whole long series of different webinars in order to help new and existing E-residents to cope with COVID-19 crisis, to start a new company and to develop the businesses. So if you are interested in webinars that have already taken place, please do see the recordings in our YouTube channel or in Facebook. And we have more interesting webinars to come. So please visit our website and see the event calendar there. Today, we have two lovely guests here from one office, Ketlin and Christina, who are going to talk about the most popular tax questions. So just a quick technical note, if you are interested in asking a question for those who are in Zoom, please do add your questions to Q&A section. Please don't ask them in chat, but in Q&A section. For those who are in Facebook, if we have time, we take questions from there as well. But we are at the moment focusing on Q&A in Zoom. But the stage is yours, Ketlin and Christina. Please do tell us what to do with the taxation in Estonia.
Good afternoon. Thank you, Raimo. And we are happy to speak about the hot topic of e-residency and of entrepreneurs from all over the world. And today I have as my guest, I'm guest of Raimo, and my guest is Ketlin, who is our head of accountant and also part of our tax team. I myself work as a head of sales, so these following top 10 questions are the ones that our clients constantly ask from us, and we constantly bombard our tax team and accountants with the same questions. So let me share the screen, just a second, and we can start. All right, so the floor is yours, Ketlin.
Good afternoon from my side also. As Christina already introduced me, I'm the head accountant in one office, Estonia. So enough about me. Let's go ahead with the topics that we have today. The key points are here that are always interesting for the clients. Is it really the way that you don't have to pay the profit tax right away at the end of the year? And also, of course, about the double taxation, how it works, with who it works, and so on. So these are the points that we are going through today. And let's start with the first question.
Okay, so the first question of today, what we constantly receive is, what is the difference between tax residency and citizenship? As I understand, then a lot of people actually mistake and confuse these two.
That is true. When we talk about citizenship and tax residency, then we also have to talk about, let's say, two persons. One is legal person, which is the company, and the other person is the natural person, basically the owner of the company or just an employee. So when we talk about citizenship, then this is only about private persons, and citizenship is determined by a passport. And tax residency is not always same as citizenship. Tax residency is determined by the tax law, and the tax residency, as I said, might be the same as citizenship, but it can change. For example, if I am Estonian citizen, but I have lived at least, let's say, 183 days in Finland, then I become Finnish tax resident and I have to pay my taxes in Finland. So that's the main thing, that tax residency is where you actually pay in which country you pay the taxes. And when we talk about company, then by the law of Estonia, the company's tax residency is the country where the Estonian company is established, which means it's in Estonia. And in many cases, when foreigners receive e-residency cards, they think that they immediately become tax residents or residents of Estonia. Unfortunately, that's not it. E-residency is just a digital identification for foreigners to run business smoothly, and unfortunately, that's it.
And I would add that the e-residency is not related to visas or not related to residence permits. So these are different things. E-residency has digital status, as Kathleen told. All right, moving on to our second question today. And this is the most commonly asked question. What are the tax benefits of Estonian company?
Well, I will start from the beginning here. That first of all, I think Estonian tax system is very simple because of this flat rates. It makes it easier to understand for the foreigners also how everything works. Then what all the company owners definitely love is that they only pay corporate income tax when they distribute dividends, which means, as I said, if you don't distribute dividends, you don't pay any corporate income tax. All the money, profit that you have in the company, you can just reinvest it, use it for growing the business, and so on. Then there are, in some cases, you can take out tax-free dividends, for example, in the case of permanent establishment or when you receive them from subsidiary. And the last one, which is very, very unique in the whole world, is that when you, as the owner of the company, are a tax resident in Estonia, then additionally to corporate income tax, you don't pay personal income tax when company pays you dividends. This is very unique, and this is, let's say, it's a gift from Estonian government to Estonians or Estonian tax residents, let's say this way, because in rest of the world, I would say, when a natural person receives dividends, then they usually have to pay the personal income tax also. In Estonia, you don't have to do that.
But do they have to pay the taxes, personal taxes in their homeland?
Exactly, they have to pay the personal income tax in their homeland.
I guess the main point from here is also that there are two levels of taxes. One is the company level and one is the private person level. And we also come to that as well, that if a company pays taxes and private person has to pay taxes, then these two are not considered as double taxation. But we come to that as well later on.
Yes.
Okay, moving on to our next question, which is quite related. What is double taxation?
Well, double taxation, as it says, basically paying same taxes in different countries. You can avoid double taxation when the country where your company is established and the country where you as a private person lives, if those two countries have double tax treaty agreements, then it can be avoided. But if those countries don't have the treaty, then there is a double taxation and there's nothing to do about it. Estonia has double tax treaty agreements with 57 countries. So this is something that definitely you should look for if your tax residency country has the agreement with Estonia. And as Christina already mentioned, natural person and legal person income tax are different taxes. when company pays out the dividends, it's the corporate income tax. And as I said, most of the countries have decided that private persons again have to pay private person income tax from the dividends that they receive. So it's not double taxation. These are two different taxes. One is corporate income tax and the other is private person income tax.
And I would add that, for instance, Estonia doesn't have double tax avoidance treaty with Russia. So it means that Estonia can ask you to pay the taxes, the corporate income tax, and Russia can ask that as well. In that case, it's double taxation if the company pays the same tax in both countries. Is that so? Yeah. All right, so moving on. The double taxation is quite, and company doing business elsewhere is really very much related to permanent establishment. And this is also something that people are not very aware of. So now we try to answer the question, what is the permanent establishment of the company?
Yes, permanent establishment takes place when most of the business, managing the company, selling goods, for example, most of the goods and services takes place in a different country than where your company is registered in. And when you permanently do that elsewhere, then you have a risk of having permanent establishment in that country where most of the business actually takes place. So for example, I have an Estonian company, but I do everything in Finland. I live in Finland. I manage company from Finland. Then I have a huge risk of having permanent establishment in Finland. Additionally to managing and selling services good permanently in a foreign country, but also can create permanent establishment for your company in another country is when you are making agreements with your clients in different country. You also negotiate about the prices anywhere else, but not here in Estonia. So these are the key points that can create permanent establishment. If that happens, first of all, Estonia is not the one who comes and says, or Estonian tax office is not the one who comes and says that you now have a permanent establishment in Finland, for example. It's the Finnish government or Finnish tax office who comes and says that it seems that you are doing everything from Finland. Now you should have a permanent establishment in Finland and pay the taxes in Finland. So, and when that happens, when let's say your Estonian company now has a permanent establishment in Finland, then to this permanent establishment now applies Finnish rules, not Estonian rules anymore. We can't go by the general rules anymore. So this is when starting the business, then it would be good to evaluate all the risks that you have regarding the permanent establishment, just to know and just to make sure that everything related to taxes is correct and you don't have anything to worry about.
I would also add that tax offices or the countries compete for our tax money. So the business owner has to be smart in that sense and analyze the tax situation and do invest in tax advice, because this might in the future you might actually save money and you will keep your nerves if you don't have to argue and then discuss with tax offices about where my taxes should be paid or should not be paid. And yeah, the permanent establishment mainly comes from where you manage or run the company from, or where you sell your services or goods permanently. But there are, as Getlin mentioned, there are so many other aspects that might create the permanent establishment. So this is all that has to be taken into account.
May I have a question as well? During the first question, you were describing or explaining the tax residency, that all the companies by default, if they are founded in Estonia, has a tax residency. How does this fit in that picture, a corporate tax residency, I mean?
Well, then what it means from the tax side is that, of course, it depends, is like full of your business done in this foreign country, then basically your tax residency becomes Finnish or this foreign country. You have to pay, you have to go according to this country's rules, taxes, everything. So for example, as I said, Estonian company, permanent establishment in Finland, then though we have in Estonia the rule that you only pay out dividends when you only pay corporate income tax when you pay out dividends, then in a case when you have permanent establishment in Finland, then Finnish law applies, and at the end of the year, you have to pay corporate income tax in Finland.
Thank you.
And actually, we had a really good example that one of our clients who has Estonian company grows reindeers in Finland, right? Yes. So there's no way that you can say that I'm doing global business if you have the kind of reindeer is a good, right? You have a product physically located in Finland and you live there as well. So.
Yes, exactly. This case was that there was already a company in Finland. The client grew the reindeers. So when all this E-Residency and Estonian company establishment came to the picture, he thought that very good, I will take it all to Estonia. But just like I will just establish company in Estonia, but I keep growing the reindeers here in Finland. So actually nothing changes. You still have everything in Finland. You still have to go according to Finnish tax law, pay the taxes in Finland. So yeah, that doesn't help much, unfortunately.
Yeah. So moving on to the next question, which is how does dividend taxation work?
Yes, so let's start with the question that when can you pay out dividends? There are a few criteria for that. First of all, you can only, at least by Estonian law, you can only distribute dividends from previous year's profit, not from current year profit. Then second of all, annual report must be submitted to the government in order to pay out the dividends, because then it's for sure everyone, what was your profit, how much you can actually pay out the dividends. And third is that the share capital must be paid in. Estonia has made it very easy to establish company without paying in the share capital right away. But in order to pay out dividends, the share capital must be paid in already. So when moving on to the taxation, then the regular tax rate for dividends is 20%. There is also reduced rate, which is 14% plus 7% of personal income tax, which is withheld. This reduced rate, let's say you can't just decide that, oh, now I would like to use this reduced rate, not the regular one. You can't choose that. So there are different or several rules for using the reduced rate. First of all, you can start using the reduced rate from the third year of the company. But that means that on the second year, you have already paid out dividends. If you haven't paid out dividends in previous years, then the regular taxation rule applies, which is 20%. if you have paid, let's say on the second year you paid out dividends, and then on the third year you again want to pay out dividends, then 1/3 of the last year dividends is with the reduced rate, and rest is taxed with the regular rate, which is 20%. And so on the fourth year, all the dividends you distributed on second, third year, you sum them up, 2/3 of them are taxed with reduced rate, and rest of it with with the regular rate. So the calculation is a bit more difficult. And what I want to point out is that when you have to use this reduced rate, 14%, and then, as I said, 7% of income tax will be withheld, then this 7% is the personal income tax, which you can use for deducting income tax when you are making your personal income tax declaration in your home country. Then you just need to get a proof from Estonian tax office that the income tax has been paid. And as I said, you can then reduce your taxes in your home country. And when you receive dividends from subsidiaries or from permanent establishment, then these are tax-free if there is a double tax treaty agreement between the countries. If there isn't, then it's not tax-free. So these are the main rules.
I would say this reduced rate is quite new in Estonia. So it's only a couple of years that it was introduced, and it's very confusing for me. And as Katlin said, the calculation is even more confusing because there are like different systems mixed in one thing, and it's not very easy to explain why it was done and how it actually how companies can actually benefit from it.
Yes, and I have to specify here is that, let's say, when one, let's say, Estonian company pays out dividends to another company with reduced rate, then they only pay the 14% of this corporate income tax. Since, let's say, the receiver of the dividends is a company, then we don't apply there this 7% of personal income tax. But if the owner of the second company are the private persons, and the second company also pays out dividends to the owners, then we have to withhold this 7% from the second company, which wasn't withheld in the first company. So basically you have to know the full structure of the dividends, who pays to who and who receives and when and so on, and the taxation can be quite crazy.
Complicated. One word, complicated. But what I wanted to add as well about the share capital contribution, so this was one of the requirements before you can pay out dividends. The idea behind that is that if you haven't put in the money to the company, then you cannot take money out of the company. So that's why this requirement is set, that first the owner or the founder of the company has to make the contribution. And once that is done, then the owner can take out money from the company. It's like a dividend payment.
Katlin, can you describe a bit what are the main rules of using this share capital that you paid in? Is it like blocked somewhere, or you can use it for the purpose of your business?
Exactly. You can, as you said, you can use it for the purpose of the business. You don't have to keep this 2,500, for example, on your bank account all the time, that like this is the minimum amount that you have to keep in the account. No, you can just use it for regular business, and that's it.
And I would say that as soon as the contribution hits company's account, you can use it right away. You don't even have to wait for the share capital registration certificate from TransferWise or LHV or whichever account you are using. So as soon as the money is on the account, you are free to use it for all your business purposes, paying invoices, paying salaries, whatever is needed there.
Yes, and actually I would like to add that one thing is paying the share capital to the bank account. Another thing is registering the share capital. This has to be done also, because otherwise, if it's paid in, but it's not registered in the business registry, then business registry doesn't see that you have paid in the share capital, and from their point of view, you don't have the right to pay out the dividends. So definitely always register the share capital payment also.
And actually, perhaps Kathleen, you can add about declaring share capital in tax office. What was that about?
Yes, you also have to, additionally to registering this in business registry, you also have to declare it in the tax office, because let's say when at some point you decide that you want to close your company, then let's say liquidate the company, you have to pay income tax from the profit. But if the 2,500 has been paid in as share capital, then 2,500 of that profit is tax-free, only if it's declared already. If it's not declared in the tax office, then it's not tax-free.
This is quite important because this is another way to legally optimize your taxes when you have done this one declaration, basically. All right, moving on to our next question, which is how salary taxation works. So many of our clients are hiring people, and not all employees are Estonian tax residents. They might be all over the world. And so here Kathleen will answer how how the salary taxation works in that case.
Yes, so as written here, if you are a tax resident here in Estonia, if you actually do work in Estonia, then all the taxes have to be paid in Estonia. In Estonia, there are two ways or two options for paying salary. One is regular salary, another one is board member salary. When we talk about the regular salary, then only these taxes have to be paid in Estonia when this person actually works in Estonia. If a person receives or employee receives salary, but regular salary, but doesn't work in Estonia, then you don't have to pay these salary taxes in Estonia. You don't, let's say, register this person as an employee in Estonia, but that doesn't mean that you don't have to pay the taxes at all. You always have to pay the salary taxes somewhere. In that case, in the case of regular salary, you have to pay the salary taxes in a country where this person actually works. And when it comes to board member salary, then the taxation is a bit different. Of course, again, when we talk about Estonian tax resident as a board member, then all the taxes will be paid in Estonia. But if the board member is foreigner and who, let's say, doesn't work or live here in Estonia, then still income tax must be paid in Estonia. Social tax, it depends, but in most cases also in Estonia. So the regular tax rates in Estonia are the personal income tax, which is the withheld income tax, is 20%. Then social tax is 33%. Employee unemployment tax is 1.6%. Employer unemployment tax is 0.8%, and pension is 2%. So, but from the salary point of view, again, I would like to say again that you have to pay the salary taxes somewhere. If it's not Estonia, it has to be somewhere else. So it's never the way that if you don't pay them in Estonia, you don't have to pay them at all.
I guess very hot topic is digital nomads, and we come across to these questions that the digital nomads say that they don't have tax residency anywhere. So it's quite difficult in that sense, right? So is there any solution?
It is difficult, but at the end of the day, it's the company who has the risk when it comes to the taxes. Because when you don't pay the taxes anywhere, then at some point, some country, let's say, pops up at some point and says that you have received salary, but I haven't seen any taxes. So they come to the company. If it's like a company who has one owner, everything is done by the same owner, then basically it's all this person's risk, either as a company or as a private person. But somewhere someone still has to pay the taxes. And as I said, the taxes should be paid in this country where you actually do the work. So I believe that at some point you are staying somewhere doing that work. So probably that's the country where you should pay the salary taxes also.
I have also country-specific comment. The pension 2%, I think it's rather important only for Estonian tax residents, right?
Yes, it's for Estonians, but it's the, let's say, general rule. But yeah, of course, if you're not Estonian tax resident and but you are working here, then usually income tax, social tax are the ones that definitely will apply for you.
And the second question is, if there is an E-resident who is a tax resident of Estonia, so spends maybe a half a year plus 1 day in Estonia, and pays the salary with social taxes and everything, what about the social guarantees by Estonia? Do they get them?
Yes. If you pay the social tax here, then you get social benefits from here. But that's also, let's say, this is also one maybe good point to, or good thing to point out, that you can have social benefit in only one country. You can, when it comes to income tax, then income tax you can pay to many different countries. But social tax should be paid only in one country, and you can actually receive social benefits from only one country. If you have received in some way social benefits from 2 different countries, then make sure that social, let's say, the governments do communicate with each other, with different countries, and they find it out quite soon, and then to one country you have to pay back all the benefits that you have received. So again, make sure, ask consultation, whatever, make sure that all the taxes are correct, so you wouldn't have this bad surprise a year later, half year later, few months later, who knows.
I would also add that taking tax consultation or that tax advice is investment, not a cost. All right, but moving on. So we come to the next question: what taxes and where an E-resident pays? Kathleen, you're muted.
Yes. That's why I was waiting. So when it comes to Estonia and E-residents, then first of all, when you pay out, when Estonian company pays out dividends, then the corporate income tax definitely have to be paid in Estonia. Then all this fringe benefit taxes, everything like this, these have to be paid in Estonia because this goes according to Estonian rules. And of course, the employees that you have working in Estonia, these all taxes must be paid in Estonia. So if you're e-resident but not Estonian tax resident and you receive dividends, then this personal income tax you have to pay in your home country from the dividends. So these are the main rules. And of course, if Estonian company pays out the dividends and you can use the reduced rate, then this withholding tax 7% also has to be paid in Estonia at first, but as I said, it can be deducted later. So these are the fees.
And this applies when the company is Estonian tax resident, correct?
Yes.
It's not if the company has permanent establishment somewhere, then this logic might not apply.
Exactly. Then the general rules don't apply.
All right. So moving on with our questions, and another very hot topic is VAT. And so Kathleen will tell when and why the company should register for the VAT and what is EORI.
Yeah, in Estonia, the threshold to register VAT is 40,000 euros, but it's only for the sales to either Estonian clients or the clients in EU. If you have clients outside of the EU, then the threshold doesn't apply. If you have clients only outside of the EU, then probably you don't need to have the VAT at all. The regular VAT rate in Estonia is 20%. There are also reduced rate for accommodation, for example, and some papers. And but of course, you can always register for the VAT before reaching the threshold. This is also what you can do. When we talk, let's say, very popular in these days is this e-commerce. Then when it comes to goods, selling goods and let's say services, then especially with goods, then you need to register the VAT in the country where the goods actually are. So whoever likes to do e-commerce business in a way that you have a company in Estonia, but the goods don't move through Estonia, then definitely try to get as much information about it before have a consultation, because in that case, usually you need to get the VAT number somewhere else. For example, you have Estonian company, you buy the goods from China, you sell them, you import them to Germany, sell to German private persons, for example, then you have to get the VAT number in Germany. If that's the only business that you have, then you don't even get the VAT number in Estonia, because you have nothing, your business doesn't have anything to do with Estonia. And when I talked about importing, then EORI is the number that you need when you import goods from outside of the Europe to Europe. And let's say if I use the same example that you have Estonian company, but you import the goods directly to, let's say, Germany, for example, then still take the EORI number in Estonia, because you should take the EORI number in the country where you have established your company. Maybe you have any questions about that? Or
I am sure that they will have.
There will be, yeah, I'm sure.
Yeah.
There will be questions, and again, when it comes to VAT, then if the business is local, then it's simple. It's very simple. If it's not local, if it's over-border business, basically, then the Estonian local VAT does not apply anymore. Then we have to go by the rules of the European VAT rules, and this is not that simple anymore. So in the case of VAT, all this taxation, salary taxation, and so on, I definitely recommend to have a consultation, and then the consultation can be very specific to your business. And then we can give you the best advice. And it's always very, let's say, reasonable to have a consultation at first when you have done anything at all, because the more information you have in the beginning, then you can build your business according to that and probably save a lot of taxes.
So planning ahead is very recommendable, and doing everything correctly is huge benefit in the future as well. And with VAT, what I wanted to say, like Kathleen said, although we are operating under EU directives, each country does their own rules. And well, Estonian rule is for once this threshold, 40,000 euros per year. And each year it starts again. So in 2020, you might be 35. You don't need to register for VAT, but you can. It's not mandatory, but it's voluntary. But if a company becomes VAT liable or has employees in Estonia, for instance, then it also has obligation to file tax declarations. And in Estonia, we do it every month. So it's on a monthly basis. There's no option to submit declarations on quarterly or annual basis. So with some benefits with the VAT number that you can claim VAT back on the services that you have bought, then there is also obligation side as well. All right.
There is also one VAT question. VAT threshold value is 40,000. Is it in Estonia only or for all EU in total?
Every country has their own threshold. So you always have to look at the threshold of each country separately.
But here in Estonia, this is from, as Kathleen said, from Estonian sales and from EU sales. So if you sell in Estonia and you sell to some other countries in EU, so this is all added up together, and this is the threshold part.
Yes, and it doesn't matter if the client is a private person or a company. If they are EU companies or private persons or Estonian companies, private persons, then this 40,000 applies, and all these sales will be summarized.
All right, so and now we basically have two more questions, and this is a question which is very interesting. What is MOSS? I hope that some of the listeners have heard about it, but who haven't, then this is the part where you have to pay attention, because this is really important.
MOSS is also part of the VAT, actually. MOSS means mini one-stop shop, basically. But MOSS regulation, it's a specific regulation to actually simplify some part of paying taxes and so on. So MOSS only concerns digital services and goods. And the regular rule is that when it comes to digital goods and services, then the place of turnover is where the client is. Usually it's on the other way around, meaning that if Estonian company provide the service, then the service takes place or turnover takes place in Estonia. It's not like this with the digital services. And in regular case, it means that if turnover takes place in some other country, at some point you have to get the VAT number in that another country. So to simplify that process, that you wouldn't have to get the VAT numbers in many different countries, then they came up in 2015 with MOSS regulation, which means that let's say, Estonian company. I sell digital services and to different private persons all over Europe. And it means that my sales invoices will be with their home country rates, but I will gather them all here in Estonia. And Estonian tax office will then spread the VAT to those different countries. It will save for me as Estonian company a lot of work, a lot of money, so I wouldn't have to get those different VAT numbers in different countries. You can have MOSS, or you can use MOSS regime only if you are VAT liable in Estonia. And these MOSS sales, you don't declare them in the monthly declarations or regular VAT declaration. There is a special MOSS declaration that you have to submit quarterly. So yeah, this is what MOSS is.
So basically, this is additional reporting or additional declaration that the VAT liable company has to do. So it's not that they do MOSS declaration once per quarter, but they have to do monthly declarations, VAT declarations plus MOSS.
Exactly. For example, if all the services that you provide is MOSS, then it doesn't mean that now you can only do quarterly declarations. You still have to submit monthly declarations, even if there's nothing much to even show there, but you still have to submit them. Monthly declarations and quarterly separately.
Mm-hmm. And what makes MOSS difficult or complicated is because is the fact that if we have so many different EU countries, then VAT rates are different, and that's why the spreading of the VAT would be, it's not that easy if you do it yourself, if it wouldn't be the MOSS system.
When it comes to MOSS, then it is very, very important that you have, let's say you as a company owner, have understood fully what it means, especially to understand, first of all, that you are selling digital goods and services, because then you have to set up a very good system to actually gather the information. Because let's say we as an accountant, we get the information from the company's owners, from the board members. There are many ways to simplify all these processes from accounting point of view, but it means that at first, board members, company owners, they have to have very nice, full information by client, by country, by VAT rates, and so on. If you have this information, it will definitely help everyone later on, from taxation part and so on.
All right, and now we get to our last question, which is how the company expenses or business expenses are taxed in Estonia.
Yes, this is again a topic where I have to tell that whoever, let's say, especially non-residents, if they establish a company in Estonia, then you have to understand that we don't have this exact same rules all over the Europe. We have some rules that are common, but mostly locally, the rules are very, very different. So what I see every day is the clients come establish a company in Estonia, and they think, or they still act the way the taxes or taxation is at their home country. And that doesn't work. And in that sense, you can again get some bad surprises regarding taxes. So when it comes to taxes in Estonia, then everything related to food, drinks, representation expenses, donations, and so on, it's all taxed. When we talk about fringe benefits, which means that, for example, food drinks for the persons related to the company, everything is taxed as fringe benefit, which means is you pay additionally taxes about 67%, and you can't deduct any VAT. When it comes to representation, for example, you take clients to the dinner, you pay for the client's accommodation or entertaining them and so on, then only 32 euros per month plus 2% from payroll is tax-free, which is very, very, very small amount. Yes, it is cumulative amount throughout the year, financial year, but still it is very small amount. Everything else will be taxed with 25%. Donations also 25%. So these are the main things that will be taxed according to Estonian rules and laws. But all the regular taxes, for example, regular expenses related to business, you have to buy computers, you have to pay for web hosting, for example, rent, utilities, and so on. This is fine. This is a regular taxation or regular expenses. You don't have to pay any additional taxes from that, and you can deduct VAT. And also business expenses, business trip expenses, meaning that train tickets, plane tickets, accommodation. This is tax-free. This is regular. These are seen as regular expenses, and you don't have to pay any additional taxes from that.
Basically, and what I would add here is as well that everything that is not related to your business will be taxed. If you are buying, I don't know, shoes to your kid, this will be taxed, right?
This will be taxed with 25%.
Yeah, so it's really important to keep separate personal funds and company funds, not to mix those, even though you might be one person company, because later on all the accounting will be more of a headache. You will have a taxation that you didn't expect, and that's why it's that's why it's really important to keep the company level separate from your private person level, in tax wise, in accounting wise.
Exactly, and also according to Estonian rule, it's important to have a document for every expense. If you don't have a document for an expense, then you have to pay again 25% for taxes for the missing document. So I know, again, different countries have different rules, but these are Estonian rules that we have to follow when you have a company in Estonia. And here, maybe I can mention it also, is that some clients have asked that, okay, I have Estonian company, but I mainly, let's say, stay in States, and there are different rules. So shouldn't I be taxed in States, for example, if I might make this kind of expenses that are not related to Estonia? Then no, you have Estonian company, and this company has to follow the rules of Estonia.
So keep your accounting in order, and accountants can help you. And if accountants tell you something, then follow these rules, because they don't just come up with that, and they don't say things just to annoy you or tease you. There is a reason behind every document they are asking, every explanation they ask from you about some transactions and so on, because they need to actually do the accounting in a correct way. So this is accounting might be a burdensome, but it is important so that the government and the business registry tax office won't come back to you and oppose some penalties or some additional taxes on your company. So you can do very much yourself in avoiding this additional hassle. And basically with that, we have come to the end of our presentation and information. Here's also really quickly my email if somebody wants to contact directly, but we will give floor to Raimo because I see that we have a lot of questions and we have half an hour to go through them.
Luckily, you have answered at least some of them already. So one last reminder for those who would love to ask some questions, please add them to Q&A section. I will start now. There was the question which we more or less already covered, like a person would like to know how the taxation works if he or she does not have tax residency personnel. Then I think we covered it already, but maybe could you remind a few main points?
Well, again, it depends what kind of expense. Let's say, if you're not Estonian tax resident, then first of all, still, if you have Estonian company, Estonian rules, general rules apply at first when it comes to different expenses. When it comes to dividends, then corporate income tax will be paid in Estonia, private person tax in your home country. So maybe these are the main differences.
What about double taxation treaty with Ukraine? Is there one or not? So how does the taxation for Ukrainians work? Basically is the question.
Mute.
Yes, I have to look at the double taxation treaties because I don't have them everything in my head, unfortunately. So maybe this is something that we can take case by case. Where who was interested in this kind of case, then you can write to Christina's email directly, and probably this person has some additional questions about the business and so on, and then we can help case by case.
I really quickly checked because my memory told that there is a double tax avoidance treaty with Ukraine, between Estonia and Ukraine, and I was right. So Estonia and Ukraine have double tax avoidance treaty, but it also means that we have to look into this treaty because different treaties are different, have different clauses in it, right? So the main frame is the same, but the regulations there might be different depending on the countries.
That's correct. Yes.
Mm-hmm. Now the question: if a person is selling the services worldwide, European Union, USA, Asia, is he in a risk to get permanent establishment in all of these countries where he or she sells to?
Well, first of all, if you have clients all over the world, then that spreads the risk quite a lot. That's one thing. But again, question is from where you do that, from where you sell the services and goods. For example, you sell the consultation. Let's say you have an Estonian company which sells consultation, but you live in Finland. For example, you provide all of it from Finland online. You manage your company from Finland. Then from that point of view, you do have the risk.
Okay. Then there's a question about submitting tax reports. When do you have to start submitting tax reports?
Okay, in Estonia, company has to submit annual report once per year, mandatory to everyone, to all of the companies. Doesn't matter if there has been any activity or not at all, you still have to submit it. The due date for submitting the declaration, annual report is 6 months after the end of the financial year. In Estonia, we don't have such thing as income tax declaration because we only pay out dividend, corporate income tax when paying out dividends. Usually, all the rest of the world has to also submit this income tax declaration. In Estonia, there isn't such thing. Only annual report.
However, if VAT is applied, then you have to declare the VAT, right?
Yes, if you have registered for VAT, then you have to submit monthly VAT declarations. If you don't submit the declarations, then there will be a penalty from tax office, 100 euros per declaration. So it's very, very important to have the declaration submitted on time. The due date for submitting VAT declaration is 20th by the next month. So we have enough time.
Okay.
And I would add that there's also salary declaration that we do monthly, and the due date is 10th. But this applies only if you have employees who are tax residents in Estonia.
But in the salary declaration, we also declare fringe benefit, donations, representation expenses, and dividends.
So even if you don't have employees, then some months there might be kind of like this personal income tax declaration or income tax declaration to be submitted because perhaps you have had personal expenses in the company or donations or something.
Or missing documents.
Or missing documents.
There is an interesting question which I tried to rephrase a bit. So basically, what are the options to pay for freelancers if they are not employees of your company?
I would say, first of all, if these freelancers are registered in some way at all as a company or something like this, and if you can invoice, that would be the simplest way. I know that every country has specific rules for that. For example, in Estonia, when you are company in some way, some level, you have a registration number. In different countries, as I said, systems are so different, and it's it's hard to see. But the thing is that if you can't get an invoice for the work, then it's seen as a salary. And and if it's possible in that country, for example, where your freelancer works, if it's possible in that country that private person can pay all the salary taxes on their own, then this should be on the contract already, that this is the fee for the work. And this person is liable for paying the taxes. But if it's not possible, then it gets a lot more complicated. Estonian company needs to register as a taxpayer in the foreign country to submit the declarations and pay the taxes. So it gets more and more difficult. Again, try to get as much information in advance before starting to make these kind of transactions.
Now the calculation exercise is expected. That's a question. Could you please make a concrete example with an Estonian employee living and working in Estonia? For example, having a 1,000 euro salary. How big is the percentage of taxes altogether? Is it 57.4?
It's an easy question, so.
What, Christina?
That's an easy question. That salary, was the salary 1,000 euros gross?
Yes.
Or gross?
No, it's not written here. Let's say gross.
Well, when it's a gross salary, and we talk about the Estonian employees, then 33% is added to the gross salary, plus 0.8 unemployment tax. These are added taxes. All the rest are withheld, which means that these are withheld from the gross salary.
Okay.
And there are actually salary calculation websites if you Google. So you can actually see like step by step what goes where, because this social tax is a company's expense, for instance, and personal income tax is what what I give from my salary, but the company takes it and gives it to the government. So
yes, and when you have Estonian employees, Estonian tax residents doing work in Estonia, then you can also use this income tax-free part, which is 500 euros per month. But for that, there are also some special regulations. So, but it's an option.
Then there are a couple of similar questions. Can we also go through briefly once again the scenario of a board member? There is a company with one board member and no workers. Is he or she automatically a employee of the company? And what kind of taxes do apply in this case?
No, you're not automatically employee of the company. Now it depends. It's for the board member to decide also what kind of salary they want to receive, because it depends what kind of work they do. If they do everything in the company, they're the only owners, only board members, they do actually fully, they do the full work, they manage the, let's say, program, sell, find clients, do all of it, then this is part of the regular salary actually. Board member salary, it's more about managing the company, seeing if everything is okay, and so on. So there are options. You can also pay both, partly regular salary, partly board member salary. So there are many options.
Okay. Then there are many questions about VAT and e-commerce, of course, but they go quite into detail. You have also some kind of package for e-commerce companies. Do I understand correctly? Christina, would you like to describe it a bit? For example, there's a question, who to contact about the VAT e-commerce package and get it done?
you can contact me. I can later on share in the chat my email once again. But yeah, because we see that e-commerce is a hot topic and people want to do this business, then we came up with a certain package. First thing is whoever starts e-commerce businesses and hasn't done that before, then specify what you are doing. And our package is specifically for Amazon sellers in UK and Germany. So you can use Estonian company. We help you to get the VAT number either in UK or in Germany or both. And if you do everything through Amazon platform, you buy your goods from there, you sell from there, then we can actually keep the monthly accounting costs fixed, which means that first you might not have so much sales, but over time, in months, you can actually scale up and the accounting cost won't increase accordingly. And this is a huge benefit because there's a huge difference whether you sell 100 euros worth of goods per month or whether you sell 10,000. But if you keep the setup standardized, then we can do very much in optimizing the cost that you have to pay in order to keep this. But right now we are focused on UK and Germany, and let's hope in the future we have more marketplaces and more setups. But right now we are working with Amazon.
Quick question connected to that one. Is MOSS, does MOSS apply for drop shipping business models?
Mostly no. Because then you are, when it comes to drop shipping, then you are usually moving actual goods, physical goods. So no. Okay.
Then there's a question, if I were to establish a company in Estonia and have the permanent establishment outside of Estonia, should I inform the Estonian tax office about it? I would, of course, do it with the foreign tax office, but is there obligation to inform Estonian one?
No.
Good. Then could you please tell us how big is the tax for fringe benefits?
For fringe benefits, it's about 67%, which means social tax, income tax, so it's a lot. So in many cases, I would say clients rather avoid this kind of, putting these kind of expenses into company at all.
And there's a question connected to that one, which we already, I think, know the answer, but is the food and the representation costs during the trip taxed or not during the business trip?
Taxed. Because again, it depends, are these your expenses related to you or related to your business partners and so on. So the taxation is different from that angle. Everything related to you as the owner of the company, related to the company, everything is taxed with fringe benefit. Everything related to the business partners is with the regular 25%.
And I would say this is the biggest difference between other countries that, yeah, in Estonia, you can't wine and dine, sorry. Or you can, but you have to pay taxes on that.
Okay. Interesting question. What could be the benefits of registering VAT number before reaching to the 40,000 euro threshold?
Let's say there's several things. First of all, if you have expenses, if you have Estonian company and you have different expenses in Estonia, maybe even quite big one, maybe you are setting up a back office here in Estonia. So meaning you have to make quite big purchases. Then it means that you can, if you already have VAT number before starting selling at all, for example, then you can get all the VAT back from these expenses, and you can use that money. The VAT you get back from the purchases, first of all, will be transferred to tax office prepayment account. And from there, you can have it transferred to your company's account, and then you can use that money. Otherwise, especially at the beginning of the company, maybe you have to give a loan to the company and so on. But then you can use this VAT that you have deducted, basically. Another thing is that if you have business partners outside of EU, then if you have VAT number and your business partner, for example, in Sweden also has VAT number, then mostly you can invoice each other with 0% VAT reverse charge. If you don't have VAT number, then this Swedish company who has VAT number, they have to add their local VAT also to the invoice, which makes it more expensive for you. So in that sense, it's more reasonable to have the VAT number before reaching the 40,000.
Where can we find the list of countries with whom Estonia has double taxation treaty agreed? The list of countries where this double taxation avoidance treaty is agreed, is it somewhere public?
It is public. Christina, you found it right away?
It's on Estonian tax office site. So there's a lot of valuable free information on that site as well.
If the Estonian resident company is a holding company and subsidiary is a foreign company, do the holding company need to pay corporate income tax? In that particular example, it's an EU country.
If Estonian company is a holding company, have a subsidiary in EU, and when the subsidiary pays out dividends, for example, to mother company in Estonia, this holding company, then first of all, this subsidiary pays all the corporate income tax. They have already paid them. And if those two countries have a double tax treaty agreement, then there can't be double taxation, which means an Estonian company can pay out the dividends in amount that they have received the dividends, tax-free, basically. There will be no corporate income tax. There surely be personal income tax, probably, if the owner is not the Estonian tax resident, but no corporate income tax.
Okay, there are a lot of questions which we already covered, and there are some very specific country-specific cases which we strongly recommend you to ask directly from one office. Let's see, what do we have here? Any suggestions? Are there any automated online services for companies around the world? I guess the question is about tax calculation. Are there any good services for that or online solutions?
That's difficult to say because, as I said, in every country there are specific rules, and also, let's say, these are locally specific. But for example, we deal every day with, let's say, clients who have a company in Estonia, but the business is totally elsewhere. So then all the taxation gets more difficult, and then you have to go in detail. And in many cases, in such cases, many times you have to get information from Estonian side and also from another country side. And then you have to put all the information together and see if it's beneficial for you or not at all. So luckily, most of the governments most of countries have a lot of information is in English, also available. But let's say,
we haven't found that tool yet. And we would be really happy to find it, actually. And this is a business idea for e-residents. You can build this tool. You will be so rich if you do that. Tax tool where all the world's taxation is put together. It would be amazing.
Yeah, we know that it's something that most of the e-residents and even locals would love to see one day. But let's see. There is also one question which, well, actually, I have two short questions about the sources of tax information. What's your suggestion? Where to start reading the main tax system information? First of all, I would love to suggest to go to our website knowledge base. There are a lot of articles about taxation written in rather easy format. So this is also definitely one source, but what do you recommend? Where to start investigating the topic?
Actually, Estonian Tax Office also has a lot of, as Christina said, a lot of good free information and about everything, about personal income tax, about e-residents also, actually, about non-residents, how to register, when to register, VAT, MOSS, from there mostly. And from there, they also directly take you to the laws and so on. So tax office, I would just
yeah, I would say as well that do the research, start from e-residency knowledge base, go to check out Estonian tax office. If you have specific tax residency, you can go to your local tax office website. So we hope that there is as much information as there is on Estonian one. And surely if you go through all this information, you have questions, mark those down. And when you have already specific questions which you can't find answer to from these websites, then this is the time where you can actually turn to us for tax advice, and we specifically look into your case and help you get through that. And taxes are a complicated matter in a sense that we even know that some clients who plan to register company, and after they they get the tax consultation from us, they actually might reconsider it. So this is we know that this is the risk, but we value more the honesty, and that the client enters to Estonia and starts to do business with Estonian company on honest terms and knows everything, is aware of all the risks and the obligations and so on. Then they can actually be successful as well. They won't have any nasty surprises and they are not disappointed.
Okay. And I am going to wrap it up with a few questions about dividends. How long can one prolong or accumulate dividends without distributing them? Is there any time limit?
No, there isn't any time limit.
Mm-hmm. And then there's one tricky question which also applies not only for e-residents but all the Estonian companies, I guess. There is an interesting case description that if one has got a note from tax board that in addition to dividends, they should also pay a salary for themselves. What are your suggestions? In which cases only paying dividends is enough? Which cases it's fair to register yourself as an employee or board member?
Well, when it comes to the law, then you can have two kinds of income in the company. One is active income, which means that you actually have to do work to get this income, make consultations, programs, so on. Another thing is passive income, which means that maybe you have invested at some point, maybe you have subsidiaries, and then you earn by those investments. You don't have to do anything, basically. You once did, now you just earn the profit. And the idea is that everything related to active income should be paid out as salary. Everything related to passive income can be paid out as dividends.
Okay, makes sense. So I think it's a good time to wrap it up. There are definitely some more questions, but if you have very detailed, very country or case specific question, you are more than welcome to contact one office or also with our support. If you are interested in tax questions in more detail, I recommend you to read our knowledge base, contact with tax board and read information on their website. The Estonian tax board is very reasonable. Don't be scared. And of course, I encourage you to watch our next webinars as well. So do you want to add anything, Kathleen and Christina?
Maybe it's just that try to find as much information in the beginning as possible, just to avoid, as Christina said, nasty surprises later on or all kinds of taxes. So whenever you have questions, rather ask them right away than deal with this nasty surprises later.
Uh-huh.
Yeah, it will be difficult to sort out from hindsight what should have been done differently. But from my side, I hope that it was useful, that we provided valuable information for you, for us as well. And we can only wish you a good day. And I hope that you bombard me with lots of emails. I put my email to the chat as well. And the recording goes out also to all the participants as well.
Yes, that's the last thing I would love to mention as well, that all the people who were registered in Zoom get a link to the recording in YouTube and slides. And for others, there will be Facebook recording. Please check out our event calendar for the next webinars. And if you are thinking of starting a company, contact one office or visit our marketplace and choose a suitable service providers for yourself. Be safe, and I think that's all for now.
Thank you.
Thank you.
Bye.
Thank you. Bye.